Howdy, everyone. This episode is brought to you by Fireblocks. Love this company. You'll be hearing all about them later from me later in the episode. But now, on with the show.
Inflation has put handcuffs on the Fed, and I am confident that we are headed into a Fed meeting where inflation's still going to be, call it 5%. At the same time that growth has slowed, maybe we'll be in a recession, and the S&P 500's down a bunch, and the Fed's going to have to make a choice. And that's going to be a very difficult choice for them to make.
All right, everyone, welcome back to another episode of On the Margin. Today, I'm joined by Mr. Peter Boockvar. Peter, welcome to the show.
Thanks for having me.
So we've got a lot of really interesting ground to cover. Markets are particularly interesting to pay attention to this week, certainly, and for the last couple months as well. I'd love to just kind of start with your 10,000-foot view of the macro, right? There are just so many things that we could touch on and pull out, right? Obviously, we could focus on the 10-year, what's going on with the dollar, equity markets in general. But there's so much stuff going on. I think it would just be helpful to get your view on how you're contextualizing everything that's going on. So what are you really focused on and paying attention to right now?
Well, I think the bottom line is we're living in a world of higher inflation, and the central bank responds to it with monetary tightening and the coincident sharp rise in interest rates, and then the spillover effect on economic activity that over many years has been very addicted to a period of low interest rates, and also markets that have been elevated for years with valuation expansion, tight credit spreads, all feeding off a very easy money type environment that has clearly changed. So to me, that's the bottom line here. And from here on out, we know we have the rise in rates. We know we have the monetary tightening as we've seen. The question is now how does the economy unfold from here? On top of all the other global issues like the war and its impact on the European economy, obviously China's approach to COVID and so on. So there's a lot of storms that are sort of coalescing together in this sort of perfect storm.
Yeah, maybe let's focus on the 10-year in general. I know in your latest note you've signaled out 3.24%, right, as kind of being the level to watch when it comes to the 10-year. Why that particular metric, and then what should we be expecting if the 10-year goes above that level?
So that was the closing high tick in the 10-year yield in November 2018, which was the last time the Fed was raising interest rates and shrinking their balance sheet at the same time. And you can also look at the 5-year. The 5-year topped out at 309 around that same within a day or two, and we're trading now looking at 306, 307. So those are the levels that I'm watching for. Now, of course, inflation in November 2018 was about 2.25% versus 8% now. So there are definitely differences. The Fed funds rate then was higher than it is today, even though we've priced in more rate hikes now than we did then. But yeah, that's from a technical standpoint. I do think that's the level we'll be watching, and I do think it's what will determine the breach of that will be obviously the inflation numbers, but in analyzing where the 10-year yield is going to go, you really have to broaden your analysis past what you think about U.S. growth and inflation and look to see how the BOJ manages yield curve control and how the European Central Bank manages the end of QE and eventual rate hikes there, because we're all in this sort of bond bubble together that is now clearly unwinding.
Yeah. One question that I have for you when we're talking about precipitously rising yields, at least in the U.S., right? I know this is a global problem as well. But, one of the things that I've been hearing is, the U.S. has something like $30 trillion worth of sovereign debt, right? And kind of the argument for why yields can't be allowed to rise is, well, that would make servicing those debt costs either impossible or just unpalatable, right? From a political perspective. So I guess at what level, my question to you is, at what level does that start to kick in, or does something like specifically in the bond market kind of break and then Powell's forced to reverse course before that happens?
Well, we're already seeing things buckle. I don't want to say break, but buckle, at least from a valuation perspective in the frothy parts of the stock market. Mm-hmm. The S&P 500 is just near 4,000 and the NASDAQ's down more than 20%. So we've already seen a response to the rise in rates. Now, taking this past that and what level starts to break things, well, we know that the pace of housing transactions is slowing. So consumers when you're combining the 20% increase in year-over-year home gains with the rise in mortgage rates, well, consumers are already saying, okay, let me wait. We'll
Mm.
see with autos. Uh, Granted, there's a lot of supply issues with having enough inventory on a dealer lot, but you have to believe that consumers are probably going to start responding to record high car prices with now rising funding costs. So it's not a question of do you reach a point, you break, and everything falls apart. You stair step it towards that eventual breakage. I
Mm.
mean, that's how cycles work. They don't go from one end to the other just like that. They progress towards it, and we're already seeing the progression of events and actions and sort of behavior that will eventually get to a point where it becomes painful. The question is what level is that? Is to your real question is, and how much of that discomfort and pain will the Fed tolerate as they want to control inflation? And that gets then to okay, where is the Fed put? Where is it the pain point in terms of the labor market that they back off, even if inflation gets high? We don't know yet, but I am confident that we are headed into a Fed meeting where inflation's still going to be, call it 5%, slower than the 8, but still more than double where they want it to be. At the same time, that growth has slowed. Maybe we'll be in a recession, and the S&P 500's down a bunch, and the Fed's going to have to make a choice. And that's going to be a very difficult choice for them to make.
It does seem like they're in kind of a Scylla Charybdis type situation here. Can you walk us through, from your perspective, how is the Fed going to prioritize that decision, right? So at the one time, it doesn't seem like there's never any political appetite really for a recession, is there? But it seems like particularly now, after a really difficult 2 years, that seems pretty unpalatable. At the same time, I think the Fed has finally woke up and remembered that price stability should even come before. That's the most important mandate that they have out of their dual mandate, or all of the things that they sort of consider. So if we kind of put ourselves in the shoes of Powell here, how is that decision going to be weighed internally, do you think?
Well, first of all, the two mandates conflict, in terms of trying to achieve them both. It should have always been price stability, but over the past year plus 2 years, when the Fed decided to be the Ministry of Social Justice, they prioritized the labor market over stable prices. And what did they get? They got a good labor market for an extra million or two people, but unstable prices for 150 million people that were already working. So was that a good trade-off? No. I think Powell learned a lesson of the 1970s, unfortunately only after the fact, that you can't have a healthy economy unless you have stable prices, which, as I just said, they turned it upside down. So I do think what they should do is continue to focus on stable prices and getting this inflation story intact, notwithstanding the economic pain around it. But these are also politicians. And there's no doubt that when congressional constituency started to call over the past year and say, hey, my cost of living is going up, what are you going to do about it? And then Joe Manchin actually wrote a letter to Jay Powell saying, hey, we have rising inflation, what are you going to do about it? This is when Powell still thought it was transitory. That was the precursor to the Fed finally waking up to the fact that they were dead wrong, badly wrong on inflation, and now they have to do something about it. So what's going to happen when the unemployment rate, which is at now 3.6%, all of a sudden gets to 5 or 6, and inflation's still at 5, aka stagflation? Are the calls going into Congress going to say, hey, I just lost my job, help me get it back? Or is it going to continue to say, my cost of living is rising 5%, because that will then filter into what the Fed does. And keep in mind, while Jay Powell, I think from here is going to go his own way, because Biden didn't want him re-nominated. He wanted Brainerd, so he doesn't feel like he owes Biden anything. But the Fed is still filled with a bunch of doves. So if you were asking me what they would end up choosing, I think they'll end up choosing the employment data and the stock market figures, in terms of returns and where credit spreads are, more so than where they think inflation will settle out at when that fork in the road is reached.
One concern of mine as well in the environment is, or in the current environment, is that, when you have these sort of untenable situations and you have people calling in and people being very upset, the government kind of steps in and tries to alleviate these concerns around rising prices, and they tend to step in and actually make things a lot worse. So the most recent example that I'll kind of give you is, with the rising cost of gas, and you're seeing this rhetoric all over the place, right? Like pain at the pump and all of that kind of priming, right? That's going on from politicians. You have, Gavin Newsom in California saying, hey, we're going to essentially subsidize, the purchase of gas, for residents of California, right? Which obviously just makes it easier to buy gas, and the prices continue to go up. And I think that's just one small example, but and you know what? Another one, right? Obviously a big component of CPI is owner's equivalent rent, right? So you start to see calls for more rent control, right? In major metropolitan areas. So, is that something that you've kind of noticed and see? It's almost like the government stepping in and kind of making the situation worse. Do you think that's a sort of a concern in these sorts of situations?
Well, Michael, that has been going on since the history of time.
Yeah.
So where they create bad incentives, and then the response to those bad incentives creates another problem that they then try to create a new program to try to deal with that consequence. I mean, it's just like the Fed. The Fed does QE, and then there's too much liquidity, and then that forces them to create a reverse repo facility and create interest on excess reserves to deal with too much. I mean, that's the nature of unfortunate nature of government, is that it's each incremental fix, while it may come with good intentions, creates its own distortion that creates its own outcome that's not wanted, that creates its own government program in order to deal with it. So it's you look at healthcare, and with good intentions in the 1960s, let's provide healthcare for older people, retirees above the age of 65, and then also people that can't afford it, and Medicaid and retirees in Medicare. Well, fast forward that 60 years, and the government dominates healthcare, and it's now 70% of the U.S. economy, and costs are still skyrocketing. And there's a new fix to whatever is broken, caused by the previous fix to whatever was broken.
Mm. Yeah, I think you could say that I've heard Mark Andreessen make the same argument about education as well, right? And it all starts from a good place, right? Which is the government steps in, they say, hey, we want our citizens to have better access to education. They subsidize the cost of education, but then they just act as a perpetual buyer, right? So universities are free to kind of jack their prices up into, ridiculously high levels.
The student loan industry.
Right.
The government now runs the student loan industry and allows schools to jack up the price. And now all of a sudden, the government has $1 trillion plus portfolio, and now they want to start letting people not pay it back. I mean, it's just, it's the history of government.
Yeah. So how do we get out of this cycle, right? Because it seems like we're at the beginnings of a trend here that's maybe moving in the wrong direction. I mean, do we just give things back to the free market? I mean, what's the kind of solution to the spiral that it seems like we're headed towards here?
Well, big picture, yes, you hand it back to the free market. Free market, it doesn't always do the right thing, but when it goes the wrong way, it quickly fixes itself. That's what makes the market. Whereas when a government the government's answer to something that's not working is just to do more of it. When the market, when it reaches a conclusion that they don't want, then they pivot and they go to the right thing. More often than not, the right thing is the initial thing, but it sort of fixes itself, where government policy just compounds each thing. And as I said, they do more of what's not working. I mean, get back to monetary policy.
Yeah.
So you look at, this goes back to Greenspan. When Greenspan cut rates to 1% after the tech bubble burst, the Fed funds rate had not been that low since, I think, the 1930s. And, well, what did that then do? It led to the housing bubble. So not learning that lesson, Bernanke then takes rates down to zero in response to the aftermath of the crash, and then does QE. And QE1 was not enough for Ben Bernanke. Then he did QE2. And then QE2 was not enough from Ben Bernanke, because, again, if what you're doing is not working, their mentality is, let's just keep doing more of it. So then we went from QE1 and QE2, that was about $600 billion each, to let's just do QE3 infinity. This has to work. And then you take it one step further with the European Central Bank. Well, cutting rates is good, let's cut rates to zero. And if cutting rates to zero is so good, let's just take them negative. And so it's the same again with on the fiscal side. It's we're not spending enough. We needed to spend more. We didn't do enough. We need to do more. I mean that's just the problem here. And when you say about when did this ends, in a way it's when the market calls it out.
Yeah.
This rise in interest rates, inflation, has basically caused the government to create a timeout. You can be sure that this inflation story has helped to kill a lot of spending bills at a conference. Congress. Build Back Better likely died because of the inflation that we're seeing. You can be sure that government spending is going to get impacted by now the rising cost of funding. So it's the market that is calling the timeout. In a way, it's the market that's taking away an inflation, the printing press of the Fed. So that is what fixes it. And it doesn't get fixed in a painless way. There's no free lunch here. It gets fixed in a painful way, but it's an inevitable fix that needs to take place if we want to somehow right this ship.
Yeah. Talking about just pushing forward with unsustainable policies, you've kind of got this great framework that I really like where you talk about transitioning from a business cycle into a credit cycle, right? And that kind of touches on what we're talking about here. Can you describe what exactly that means for listeners?
Well, this goes back decades with Greenspan, where his lever to manipulate the economy was to change the cost of capital with the Fed funds rate, and lower it when he thought that the economy was hitting a bumpy road, and raise it when he thought that there was risk of overheating, and also having asset prices drive the economic bus, and that he was more focused on the S&P 500 and this wealth effect than he was like having the economy grow on a foundation of savings. I learned in college that savings equals investment. Well, now, central banks have made it, easy credit now equals investment. That's what they did. They said, no reason to save that much. We'll lower the cost of capital and let you purchase that machine today instead of waiting till tomorrow. We'll lower mortgage rates to allow you to buy that home today with only 5% down instead of saving up for 20% down that would take you another year or two to do. We'll lower the cost of capital and funding so you can buy the car today instead of saving up money that you can buy it tomorrow. And so therefore we created a lot of borrowing, and we became much more sensitive to the ebbs and flows of monetary policy and the ups and downs of the cost of capital, aka we now have credit cycles instead of normal economic cycles that were driven by inventory adjustments and other more natural economic imbalances that corrected itself, rather than depending on where interest rates go.
What is the consequence of this? Because one trend that I've kind of noticed over the course, let's say 10 or 15 years, is it looks like what central banks are trying to do, right, with QE and other policies like that, is at least one output is kind of suppressing volatility, right? And recently we've kind of had these extreme bouts of volatility as the world has essentially gotten levered to lower and lower interest rates, right, and higher amounts of debt. So, you had obviously 2008 and the world kind of blew up. Then you had 2020. And now if you look at the route that's going on in markets today, I mean, this is pretty unprecedented. I think this is the worst opening for the 10-year in a recorded history, or since 1787 or some crazy year, right? So, I mean, is one of the inevitable outcomes of this almost like central banks trying to grab onto markets like this increased volatility as we kind of reach the logical limits of their positions, or is there kind of no end here, right, to what they can do?
Well, their purpose, and this goes back to Greenspan again, I'll continue to go back to him when he was nicknamed the maestro. Like, he was able to just smooth out these economic cycles with his magic touch. Mm-hmm. But that touch was him playing God over the cost of money, that he knew best where interest rates should be. And his committee around this big mahogany table in Washington, D.C., they knew best where the cost of money should be. And for a period of time that works, and then it eventually doesn't. And when it eventually doesn't is when you get higher inflation. And that is the environment that we're in now. Because until we had this inflation spike, central banks have had a free pass to experiment, to do whatever they wanted, because the market sort of and the economy gave them that leeway because there was very little inflation. Oh, go print $1 trillion a year, no problem. Inflation's low. There's no consequence. Oh, go leave interest rates at zero for 7 years, no problem, no consequence with inflation. But now that we have this higher inflation, that's when this whole modern day central bank orthodoxy gets called into question. Well, why did they want higher inflation? Why do they want 2%? Why were they pressing so hard to get it? Because why would it automatically stop at 2? Why was inflation asymmetry a good policy where you would tolerate a period of higher inflation above 2% to offset a period of lower one? Well, what happens if the upper end starts going well above like we're in now? Well, how's that for symmetry? So I think that in a good way right now, where people are finally questioning this sort of godlike bending down that the markets have taken to the Fed, thinking that it's this incredible institution that does only right. And I think they're one of the most dangerous and economically damaging institutions that this country has ever seen. And just go ask a couple that just got married that are in their late 20s that are trying to buy a house. Well, it's not just, okay, there aren't enough for me to buy and therefore prices are up. No, it's the Fed that has juiced multiple housing booms and have made it unaffordable, both from a renter perspective and a homeowner perspective, and they're to blame. And hopefully now is their opportunity to get called out and fully exposed, because up until this point, they were sort of the wizard behind the curtain.
Yeah.
And now that curtain is being pulled aside and they're being shown for what they really are. Just a bunch of human beings, again, that tried to play God over interest rates. And now that experiment has gone awry.
I think that's a really important point that doesn't get brought up enough. I mean, it's kind of like that idea that nobody really cares what's under the hood as long as it's working. But to your point, things are very publicly not working anymore, right? And I don't know, I'm sure someone does these sorts of polls, but if you even asked how many people in the United States knew about the Federal Reserve, let alone who the chairman was 10 years ago versus today, I would say it's much, much higher today. And obviously Americans are feeling a tremendous amount of pain right now, right? Pain at the pump, right? As our politicians like to say, but certainly they're seeing their real wages decrease, right? In the face of inflation, a potential recession on the horizon. And I feel like they're going to be looking for a boogeyman or someone to blame, right? And who better than the guy who's been running the money printer, Jerome Powell? I don't know.
And going into the midterm elections, and I'm not going to turn it into a political thing. I'm only bringing it up because you're going to see a lot of commercials. Both sides are going to blast the airwaves with commercials. And at least the Republican side, that their commercials are going to be, oh, look, inflation, inflation, inflation. And, they're going to point their finger at Congress, and I'm sure they're going to point their finger at Jay Powell as well. Now, both parties are to blame. Just as Biden spent a lot of money, Trump spent a lot of money too. In fact, both parties spent $5 trillion over 2 years. So Congress has a lot to blame too for the inflation that we're in right now, and that you had $5 trillion of money spent by both parties over 2 years at the same time that the Fed was financing a lot of it. That you don't need to take economics 101 to understand that that's going to eventually lead to inflation.
This episode is brought to you by Fireblocks. I talked to a lot of fast-growing crypto-native funds, crypto banks, exchanges, and the like, and they all tell me they have the same two problems. One, their treasury management setup sucks. They've got analysts wasting time and money on manual transactions. Two, they are not happy with their current security setup. They're sharing passwords, they're sending test transactions, and they're worried that their funds might be at risk. Fireblocks is a platform that solves all of that for you. They are a one-stop shop portal which automatically plugs into exchanges, trading venues, etc. They source deep liquidity and solve everything from day-to-day crypto transactions all the way down to complex DeFi strategy. And the best thing about Fireblocks is that they offer scalable solutions with industry-leading technology. Doesn't matter if you're a 2-person crypto fund or a 2,000-person crypto exchange, these guys have you covered. And the last thing that I'll say about this company is that I have known them for years. They are a high-integrity team. They ship product like no other. I would trust them with my own funds. So, click the link at the bottom of this page and tell them that I sent you. Very, very important that you click the link at the bottom here. Otherwise, they're not going to know that I sent you, and then how am I going to get credit? So help a brother out. Click the link at the bottom of this episode Tell him I sent you. I want to get your thought here, right? The CPI handle is, gone above 8, right? It's like the highest CPI we've seen since the 1980s. And, the kind of popular rhetoric that you hear, the narrative is that this is the dollar turning into toilet paper, right? But actually the dollar, especially in the last couple of months, has strengthened pretty precipitously. I know most folks point to the DXY. I know you have another preferred index that you pay attention to when it comes to the dollar. Can you just kind of explain the dollar's rise in the face of all of these challenges and inflation, which should seemingly having it go lower?
Well, 70% of DXY is the euro and the yen. So it's obviously very skewed to those big currencies. And then you throw in the pound, the Swiss franc, I think the Canadian dollar. I like to look at the trade weighted dollar because it's a little bit more diversified. And it's what really matters because since we trade a lot with Canada and Mexico, well, we should rate the peso and the Canadian dollar more than we do the yen. And we
Right.
do obviously trade with Japan, but we trade a lot more with Canada. So why do we focus more on the yen than the Canadian dollar? Now, the dollar has been obviously very strong, as you point out, but up until a couple of weeks ago, it was really only strong against the euro, the yen, and the pound. We know why it's strong against the euro. Eurozone's probably in a recession, and obviously, with the spike in energy prices and the war, it's very easy to explain. It's strong against the yen because, well, the Bank of Japan has yield curve control at 25 basis points, and their monetary policy is in a different universe than even where the Fed is today. So the dollar strength is pretty much all interest rate differentials. Now, over the last couple of weeks, it started to rally against other currencies. And up until then, all the commodity currencies were trading much better against the dollar. It was only a few weeks ago that the Brazilian real was at a 2-year high against the dollar, that the Mexican peso was at a multi-year high against the dollar, that the Canadian dollar, the Aussie dollar, South African rand all traded fine against the dollar. It's just when now a lot of correlations are moving to one and everything's selling off that the dollar is now rallying against a bunch of different things. But it's not because the dollar is just this great thing. It's just a lot of interest rate differentials. Now, at some point, I don't know when, we'll shift back to the very large and record trade deficit in the U.S., the very high budget deficits that tend to be a drag on the dollar, and that will be sort of again at some point a mitigating influence, but not yet. But I think we have to put the dollar move into perspective, and I do, getting to your point about the trade weighted, it's very easy for people to say, oh, the dollar's up or the dollar's down. Well, I like to get under the hood and see which currencies it's up and down against, and be
Hmm.
more detailed about that, because sometimes that tells a different story.
How much do global central banks pay attention to the strength of the dollar, right? Obviously, the vast majority of global trade is denominated in US dollars, especially for emerging markets. A strong dollar can be really problematic, right? So it's been, and I know when it comes to the dollar, it's not just the actual level that the DXY is up, it's also the rate of change, which has been pretty fast, I think, by historical standards, at least over the course of the last couple of weeks. So, I mean, how closely do you think central banks are kind of monitoring the strength of the dollar?
Well, when they all wanted 2% inflation and we were below that, they were all focused on weakening their currencies. It was
Right,
a race to the base.
right.
And when the ECB went negative, the euro went from 140 to 110.
Hmm.
We know the yen has weakened with what the Bank of Japan has done. They all want to weaken their currency when they think inflation is too low, nonsensically. Now that inflation is too high, they're all seeing weaker currencies that is only exaggerating that inflation. And in fact, I saw the Reserve Bank of India today saying that they actually may start to intervene to try to cap the strength in the weakness in the rupee versus the dollar. I mean, even Japan, you have the Bank of Japan that's purposely trying to weaken the yen via their policy, but at the same time, they don't want to weaken yen. At the same time, the Ministry of Finance says, yeah, keep going with your 2% inflation target, but we don't like the weak yen. So now I think we're at a point where countries are not happy with the strength in the dollar. It obviously has deleterious impacts on balance of payments and a lot of debt that's denominated in dollars that a lot of foreign countries have, even though a bunch of countries do have offsets in dollar reserves. So it's not the worst thing, and reserves in their own currency as well. So they're much better off. But it's causing a problem, and also just adds to the global tightening of financial conditions that is underway.
I'm not sure how much you've read into or follow Zoltan Poszar and kind of some of the work that he's done in this new framework that he's laid out for Bretton Woods 3. But I wanna get your thoughts on it because you guys actually both kind of came to the same conclusion about QE, right? And how long central banks can kind of play this game of QT and selling off assets, et cetera. So I kind of heard you talk about, so this is a bit of a leading question, but I'd love to get your thoughts on just the status of the United States dollar as the reserve currency, especially how sanctions are kind of impacting the role of that, right? Especially the seizure of, some 400 billion or so from the central bank of Russia, right? So the dollar has had this very privileged role as, the center of the global financial system. How do you see that changing, I guess, over the course of the next, let's say 10 or 20 years? And what is the role of like sanctions and just kind of increasing intervention and use of the dollar as a tool for foreign policy?
Well, I think the dollar will always be a reserve currency. And I say a reserve as opposed to the reserve currency, because I wouldn't be surprised over the next 10 to 20 years that there's a lot more euros being used, there's a lot more Chinese yuan being used, and that there are multiple reserve currencies. And to your point about the sanctions that we put on the Russian central bank that essentially froze more than half of their reserves, you have to believe that other central banks are saying, why am I going to hold so many dollars and euros in reserves when the US and the European Union can confiscate my reserves if they don't like what I'm doing? So it probably freaked out the Chinese, which own more than a trillion US dollars in treasuries, or I'm sure it even freaked out the Bank of Japan, where the Japanese are the largest foreign holder of US treasuries, holding 1.3 trillion. Why would they not diversify into yuan or into buying more gold or owning other currencies like the Canadian dollar, even though obviously it's much smaller and they can freeze assets too. All you have to do is ask Justin Trudeau. But the
Yeah.
point is diversifying away from the dollar, still being a reserve currency, but just part of a group as opposed to being the sole one. Now, most transactions will still take place in the dollar, and the dollar will still have its preeminent role, but ever less so when you look out over the next 10 to 20 years, especially if more transactions all of a sudden start taking place in the energy world with you not using dollars. I mean, it became the petrodollar because in the
Right.
1970s we agreed with the Saudis to basically transact mostly in U.S. dollars when it comes to oil. Well, if all of a sudden the Chinese are going to transact in renminbi, and that all of a sudden incentivizes maybe other countries to transact with the Saudis in other currencies, all of a sudden there's no such thing as a petrodollar anymore.
You kind of hear smatterings about this, right? Even before the fighting broke out in Ukraine, there was a deal that was signed for like a 30-year pipeline between Russia and China that was going to be settled in euros, right? Saudi Arabia, I know they've been making rumblings about this for a long time, but they're also starting to publicly investigate, right? Taking payment for their gas in non-US dollars. You kind of hear these stories, and one narrative of that is, hey, the world is really sick of the dollar payment system in general, and they're looking for alternative settlement systems. And then the other side of that narrative would be, yeah, but they've never really done that in any significant size or anything like that. So when you hear those sorts of stories, do you view them as being significant, or is it kind of small potatoes and it's really still king dollar and nothing to worry about?
Well, I think it's significant in that it's a change in psychology, and change doesn't happen overnight. It happens in a progression of events that leads to a change that people wake up to.
Right.
So we're seeing, baby steps of things happening that, again, don't equal anything big right now. But if you add this up, if it continues, then all of a sudden it becomes a big deal. And this is again, a progression of events rather than just one event. It's a process, not an event, I should say, and that it's going to take place over a long period of time. But again, at least shows you that the winds have changed. We potentially are on the cusp of a new world order and getting back to Zoltan's Bretton Woods 3.0, however he wants to call it, or whatever. Sanctioning the central bank of Russia definitely was a potentially game changing FX slash global event.
Yeah. Yeah, I'd have to agree with you there. And obviously in Zoltan's framework, there's an increased highlight on the importance of commodities, right? He's got this kind of great line, which is really easy to conceptualize, which is that you can't print wheat or barrels of oil, right? So, maybe one effect of this, right, especially as the U.S. is kind of frozen its assets abroad, is that the one says, hey, actually, these paper assets might not be as important as we were. Might not have the value that we were ascribing to them. And really, at the end of the day, what it comes down to is we need energy to heat the homes of our citizens. We need food so that people can eat and not starve. And it seems like there might be an increase in the importance of commodities, actually, in terms of how even like FX markets work.
Well, it would be a new gold standard, but it will be a commodity standard instead of just looking at gold. And
Right.
that's sort of the structure that he's talking about us getting towards, and that
Hmm.
maybe that creates that creates a bunch of different things where currencies are tethered to something, but also his point is that we talk about the world of commodities. A lot of it is trade financed, and that if you're buying a bunch of barrels of oil from the Saudis, you're buying a bunch of if the Egyptians are buying a bunch of wheat from India, that you need trade finance to finance it because those are a lot of dollars. So that gets into what he's talking about and how this would be sort of a different world because what happens if that was financed in non-dollars and that was financed in local currency to local currency? You definitely have a different world and a different value of the U.S. dollar in this new world.
I just want to get your thoughts, as we kind of move towards the close here on equity markets in general. Maybe we could start with the U.S. equity market in general. It's been definitely a rough start to the year for stocks as well, particularly some of the higher, the riskier growth tech stocks, right? You've got kind of those pandemic era darlings, right? Like the Pelotons and the Zooms of the world that have done, in the case of Zoom, a complete round trip to 2020, March of 2020 prices. In the case of Peloton, below where they were trading, right? Going into the pandemic, actually. And the indices are starting to slide as well, right? I mean, it's been like 6 straight weeks of declines, essentially. I'd love to get your thoughts just in general on, I know you're a believer in value over growth, right? For the next, certainly foreseeable future, but like walk us kind of through how you're thinking about equity markets in general right now.
Well, this is the most aggressive monetary tightening we've seen in 40 years between rate hikes and QT. And keep in mind, QE was purposely meant to ease financial conditions and raise stock prices. Ben Bernanke told us himself in a Washington Post editorial in November 2010. So, well, if QE was meant to lift stock prices and ease financial conditions, well, QT is going to do the exact opposite. Then you throw in, of course, a very aggressive and rapid increase in interest rates, and valuations now all of a sudden matter. And I've always said that valuations don't matter until they do. And it was not so far away from June 2021, after the meme peak in February 2021, when Powell said we're now thinking about tapering, when all of a sudden that accelerated the valuation rethink in a lot of these high flying stocks that then obviously carried over into this year. So we've had this valuation readjustment, but the S&P 500 is still trading at 18 times earnings. And the question now is, can those earnings actually be delivered? If we're going to see what I think is going to be a more pronounced economic slowdown as the year progresses, the earnings estimates for the S&P 500 that are currently out there, consensus, and that people are deriving their PE multiples on, to me is a pipe dream. So you now have shrinking PE multiples at the same time you're on the cusp of seeing what I believe will be shrinking the E part of that. And that's going to make investing in stocks more difficult, and that's going to make valuations become more important. So when I say value over growth, I know people have been debating this back and forth for God knows how long, and growth has done well, and value, and why would we do that and growth, blah blah blah. Well, and value can get cheaper, but the thing about value is that value has low expectations already embedded in it. And in this kind of environment, would I rather be buying a stock with a 12 PE that makes money, or a 30 PE stock that, well, maybe not 30p because they're not making any money. So maybe 12 times sales with no earnings, or would I rather pay 12 times earnings. I'd rather pay 12 times earnings right now, even if that growth rate was a little less than the 12 times sales multiple that are being put on other names.
Mm.
And keep in mind that a lot of stocks are traded at 40 times sales. They didn't make any money. They go to 20 times sales. That's a 50% haircut in the stock. If it then goes to 10 times sales, which is still expensive, that's a 75% haircut in that stock with no change in the fundamentals, just a valuation rethink. I mean, for those that were not trading in March 2000, the stock of Intel and Cisco are still not back to where they were in March 2000.
Yeah, it's absolutely brutal. And the other point is that for many investors, I mean, this last bull market has lasted something like 13 years, right? And really, we could be describing the same dynamic that's been occurring since 2000, or if you want to take it all the way back to 1987. So this kind of mentality of just buy the dip and the Fed will come in and save things. I mean, that's what many investors, that's the only regime they've really known for their entire investing careers, which adds kind of an element of human risk.
Absolutely. Inflation has put handcuffs on the Fed.
Mm-hmm.
And that's what makes this investing landscape much different than anything we've seen over the last 40 years.
My last question to you is, when and if do you think the Fed reflips the switch to QE? Because the very last note in this note from Zoltan is the Fed will do QE again by summer of 2023. So my question to you is, how long is the current policy of monetary tightening, taking items off the Fed's balance sheet, raising interest rates, how long is that really sustainable before they flip that back to QE, or do you think they will?
Things always change when there's a pain point reached that cannot be taken anymore.
Mm-hmm.
Powell couldn't take the 20% decline in the stock market in the fourth quarter of 2018. Therefore, he pivoted. Bernanke couldn't take the stock market downturn after QE2 ended, and that paved the way. And the economy wasn't growing fast enough. That paved the way for QE3. So you don't know it until you see it. You don't know it until the Fed screams mercy, and that's when they pivot. Because it gets back to the whole Mike Tyson thing. The Fed has a plan of what they want to do. But now they're beginning to get punched in the face. And at what point does it start to hurt that they throw out the original plan out the window? We're headed in that direction. I just don't know when that full right hook has fully connected, but it will.
Anything that folks should be looking out for, right? What that right hook might look like could be stress in short-term funding markets, could be another 15% in the S&P, maybe at an accelerated rate. Like, what are a couple of things that maybe you're watching, you think that the Fed might be watching in particular?
It's going to be a combination of that. It will also be a rise in the unemployment rate that the Fed, of course, focuses on. They got the dual mandate, they'll say, and that if all of a sudden the unemployment rate starts to gap up and companies are saying, you know what, I need to retrench, and not only am I going to limit my hirings, I'm going to start looking at firings. My profit margins are getting squeezed. Maybe I can no longer pass on my price pressures onto the consumer. I need to start cutting my labor costs. That's when the constituency starts to call the Congress people, and that's when Jay Powell, in his semi-annual testimony, starts getting questioned about the labor market as much as he gets questioned about inflation. Because now all the questions to Jay Powell are on inflation. Prior to that is, okay, what are you doing to help the jobs market? So it's all going to happen around the same time, because all these events are happening together because they're all intertwined. You can't separate out monetary policy from the economy. You can't separate out monetary policy from the markets. And you can't separate out the markets from the economy, because they all are glued together, and you cannot separate them out.
Yeah, very well said. Peter, I know we're running low on time here. If folks want to find out more about you or the good work that you do, what's the best way for them to get more information, follow you?
So if they want to read my daily missives, they can go to bookreport.com, BOOCK report.com. And I'm also the CIO and a portfolio manager at Bleakley, where we are a wealth management firm. And if they want to learn more about us, they can go to bleakley.com and reach out to us.
Awesome. All right, Peter. Well, this has been a ton of fun. Definitely given us all a lot to think about. Thanks so much. We'll have to have you back on the show again soon.
I appreciate having me on. Thanks so much.